All right, 25 minutes to 7 o'clock here on Power Business with me, Nosipho Khatebe. We turn to this now. Altron FinTech released earlier today its Household Resilience Index for the second quarter of 2024, confirming the continued financial pressure on South African households. Now, economist Dr. Roelof Botha joins us on the line to unpack the latest findings. Dr. Roelof, a very good evening and welcome to Power Business.
Thank you.
All right. Apologies, sorry. It's Dr. Roelof, not Dr. Roelof.
That's close enough.
Thank you. All right. So the index, highlights then a 36% increase in the ratio of a household income spent on servicing debt compared to 2022. How are South African households, coping with this heightened financial burden?
Not very well. We've seen an increase in unemployment. We've seen an increase in the bank loans that are up for legal action, and it's really if you look at for instance, the Better Bond Index of home loan applications, that is down by about 30% since the Monetary Policy Committee decided to raise interest rates for no particular reason, because inflation was not caused by demand factors. It was caused by the 700% increase in global freight shipping rates and by the 400% increase in the oil price just after COVID. And that's what led to the spike in inflation globally. Now, to combat that with high interest rates, all you are doing is you are hurting the economy.
And I want to know from you, Dr. Roelof, with debt costs at their highest, in 15 years, what strategies are households using to navigate these challenges, and how sustainable are these strategies in the long term?
Yes, well, unfortunately, as we mentioned earlier, the credit impairments by the banks have ticked up a little bit. Fortunately, quarter on quarter, that's only, it's not so bad as it was compared to the first quarter of 2020. But obviously, all they have been doing is a lot of what they've been doing is to buy a little bit wiser. I've seen a trend myself, and it was in the media, for the manufacturers of an array of household goods, especially in the food categories. For instance, tomato sauce, to go for smaller packaging, because people tend to they obviously have to be careful when they are paying 9.1% now of disposable income on servicing debt. And that is a huge problem and a concern to everybody out there. Why the Monetary Policy Committee has opted for such an extremely restrictive policy stance is absolutely beyond my comprehension.
Mm. And, with then the index showing negative trends in household disposable incomes and the real estate market suffering from reduced home loan applications, how do you foresee these sectors recovering, especially with high interest rates?
Well, fortunately, we've had a clear signal that rates are going to decline. They have declined last month by 25 basis points. Now, I just want to inform the listeners before they get too excited about this, and I'm an optimist. I'm called a sunshine economist. But really, the monetary policy of this country is the biggest single obstacle to growth. So they gave us 25 basis points. In the same week, the inflation rate came down by 20 basis points. So, if you take the rounding into consideration, the real prime rate, which is 11.5% as we speak, minus the CPI, Consumer Price Index, inflation rate, which is 4.4% as we speak, that remained at 7.1% because the prime rate came down a little bit, but inflation came down a little bit as well. So actually they gave us nothing. And this is frightening because interest rates should never have gone up to these heights.
And, speaking then of the current conditions that we're in and that, consumers are feeling, what is then the outlook for private sector job creation with potential interest rates cuts on the horizon following that 25 basis points cut that we just spoke about? Will this be enough to offset the unemployment crisis, especially with the rise in discouraged job seekers?
No, I don't think so. Right now, the economy, I believe, is in the process of switching to growth mode. And despite this huge obstacle, the high cost of capital, which acts as a tax on venture capital as well, it has just become too easy the last 2 years for businesses, individuals with a bit of money, instead of expanding their businesses and creating jobs, you can just slap it into a fixed deposit and earn between 10 and 12%. So really, it wasn't a very wise decision. But we are moving into growth mode. We've seen the changes with the government of national unity. There seems to be a move towards much greater efficiency in the public sector, repairing the railway lines, improving the efficiency at Durban Harbour, fixing some roads, and very importantly, starting to move into desperate municipalities where, for whatever reason, there is no functionality, and starting to fix that. So I really foresee a period in the next 2 quarters of significant job growth, especially if the interest rates can come down further. I'm looking at 50 basis points in November. Let's hope.
Yeah, let us hope. But Dr. Roelof, then, do you believe then the current government's closer relationship with business leaders is sufficient to stimulate the economy, or are more structural reforms needed to complement the lowering of interest rates?
I think it's important for listeners to appreciate the fact that government's closer participation with the private sector is not to assist bakers to bake more bread and better quality bread. It is, in fact, to repair and expand South Africa's infrastructure. So through the National Logistics Crisis Committee, as far as energy is concerned, we're doing very well, except that we need to really get to grips with expanding the grid. There are several other indices like the AfriMat Construction Index, the Drive.co.za Motor Index, which are also pointing in the right direction. Just about all of them are moving up. The gold price is pretty nifty. It always helps us. I would say probably 9 out of 10 key indicators are telling us that next year we could have 3% growth and perhaps even 5% growth in 2026.
Mm-hmm. And then finally, what specific measures then should policymakers consider then to enhance household resilience and reduce the financial strain caused by high debt costs?
Well, the 2 issues that are close at hand is just lower the interest rates, even if government should actually consider to broaden the composition of the Monetary Policy Committee to also involve economists from the private sector and economists, for instance, that are working at National Treasury, their chief economists perhaps, and trading industry, because the interest rates are the biggest single problem. If especially the Department of Public Works can work more closely with the private sector in specific job creation schemes, for instance, taking the illegal dumping sites, turning them into revenue-generating plants, all you need is the right equipment and the right skills, project managers, some engineers, good accountability, etc. We could create literally millions of jobs. We created 8 million jobs when Mbeki was president through the RDP housing program, when we built 3 million RDP houses. So we could resuscitate that program as well. There are so many policy measures that can be taken.
All right, Dr. Roelof, I'm going to leave it there. Thank you so much for your insights this evening. Really appreciated your time.
Take care.
All right, that was Dr. Roelof Botha, economist, taking us through the Altron FinTech Household Financial Resilience Index for the second quarter of 2024. That takes us to 16 minutes to 7 o'clock.